Hello and welcome to Livewire Markets. My name is Chris Conway. 2025 was a wild and unique investing year, and if the early events of 2026 are anything to go by, we could be in for more of the same over the next 12 months. With that in mind, early this year, I want to speak to fund managers with long tenure in markets, those that maybe have seen this sort of movie before and will know how to react to the ever-changing circumstances. In that vein, today I'm having a chat with Joye from Coolabah. He's going to be talking to us about how he's seeing the investment landscape in fixed income as we head into 2026. Chris, welcome to Livewire. It's always great to see you. Thanks for taking some time to have a chat.
Thank you for having me again. Appreciate the opportunity to have a bit of a chat.
There's so much going on in the world at the moment across so many dimensions. So economic, political, technological. I just want to understand what you're prioritizing as the most important factors as we head into the investing year that will be 2026.
Yeah, so for us, it's really a lot about, interestingly, politics. A lot of the time, politics is utterly uninteresting, but I think Donald Trump is reshaping the economics and geopolitics of the world in which we live. And his policy postures and platforms have been really very extremely radical. If you think about the tariff program, the tax cuts, the unilateral action in Iran, interventions in Venezuela, and this America First regime that is involving many preemptive, ostensibly non-multilateral decisions focused on the primacy of American interests. These decisions are establishing all sorts of new precedents for both democratic and non-democratic actors, and they're really disrupting very deeply the world in which we live. If you think about the fact that Donald Trump has not only brought some peace to the Middle East, more or less single-handedly with their interventions in the Iran-Israel conflict, but also he's completely reshaped fiscal policy and defence policy in Europe by forcing NATO members to commit to spending 5% of GDP on military expenditures. He's forced the Germans to junk many decades of fiscal austerity, and they're committing to hundreds of billions of dollars of new defence spending. In the process, he's metamorphosized bond markets, interest rate expectations, likely the direction of inflation, as we were chatting, off the record moments ago. He's obviously waging a really interesting war with the current chair of the Fed. So I think heading into 2026, understanding those dynamics, last year we were strongly of the view that the easing cycle would be very shallow, and the big risk for 26, 27, 28 was interest rate increases. When we were arguing this in the middle part of last year, there were no rate hikes at all priced for Australia or the US over 26, 27, 28. And that's now undergone a significant reassessment. We've had a big increase in long-term interest rates. We've seen the Aussie 10-year government bond yield move from below 4% up towards 5%. We've seen hikes reappear in the yield curve in circa 2028. We've seen hikes reappear and that's the US yield curve, in the Aussie yield curve for 2026. So this year we have 1 to 2 hikes priced, having previously had markets expect the RBA would be continuing to cut rates from the current 3.6% cash rate down to 3% or less. So I think it's a very, very uncertain world. There are huge opportunities. If you overlay the AI revolution, that's massive. The hyperscaler CapEx spending, that's massive. People think that's deflationary or disinflationary. We've argued that it's inflationary in the short to medium term, particularly given the tendency of hyperscalers to understate their CapEx. So there's so much going on, and it's fascinating for a bond market participant.
Well, that was one of the follow-up questions that I was thinking about, Chris, just as you were covering the lay of the land there. You talked about it creating huge opportunities. It seems like a target-rich environment at the moment. Is the key going to be for you figuring out which trades to pursue and which to let go? Is that really the key? Because you can't trade everything and go after every opportunity all the time, I would have thought. Is that right or wrong?
Yeah, so interestingly, from a public perspective, we spend a lot of time talking about macro and some of these top-down considerations. But from an investment process perspective, we're really focused on executing $500 million to $1 billion worth of trades a day. And we're focused on the micro challenge of just pricing bonds all around the world in US dollars, euros, Aussie dollars, New Zealand dollars, sterling, and other markets. So, we have a team of almost 60 professionals around the world in London, Miami, Auckland, Sydney, Melbourne. We run about 80 different bond pricing models around the world. And our wheelhouse is just pricing the right interest rate for a high-grade liquid bond or debt security to pass at any given point in time. And that's all we're really interested in. So for us, we want to find as many mispricings as possible. For us, we want to trade as much as possible. We find every day big opportunities in the new issue or primary markets and in the secondary markets, and we're hyperactive in those domains. We don't really trade macro much. So notwithstanding, again, like I tend to spend a lot of time talking about macro because I think it's interesting, and I spend a lot of time writing for the Financial Review and for Livewire about macro. We don't really trade macro at all. It's very rare for macro to influence our process. At the margin, it can. And sometimes we do use our quant macro forecasting to tune our processes at the margin, but that's irregular and episodic. But I do think, to be clear, not to sound contradictory, we passionately believe that we need to try and understand macro as much as possible, and that we have a responsibility to do so, and we need to try and quantitatively appraise and project everything in the macro world that we can forecast. So we do a huge amount of quant macro forecasting. Kieran Davies is prolific on Livewire's website, and he sometimes publicly releases our forecasts and analyses. So for us, it's not about focusing on specific trades. We actually want to trade as much as possible, but focusing on the micro task of pricing riskless debt securities that are very liquid, and that's what we do all day, every day.
Well, let's pivot back to the macro, Chris, because it augurs well for rich conversation. You wrote a piece recently calling out the RBA for not doing more to talk down and jawbone the excessive spending of our politicians. A couple of questions off the back of that. How do you think it resolves? So do politicians blink first, or does the RBA eventually have to reassert itself? And then a bigger question, why do you think we have this lack of strong leadership in Australia at the moment?
Yeah, there's a few important topics, I think, embedded in that line of questioning. So the backstory here is during the pandemic, under the leadership of Phil Lowe, the RBA was very vocal in encouraging politicians to spend as much possible, spend as much money as possible to create a bridge to the advent of durable vaccines. And I thought that was sensible. But when they opened that door for federal and state politicians to spend a huge amount, almost, or actually literally unprecedented amounts of money, they never really closed it, and that was the mistake. So once the pandemic passed and our economic security was obtained and crystallized, the RBA sort of disappeared from the public narrative in respect of political spending and more specifically fiscal policy. So since the pandemic, we've continued to run massive budget deficits at the federal and state levels. So we're borrowing from future taxpayers to spend money today to basically buy votes in a very myopic and I think irresponsible fashion. At the time in the pandemic, interest rates were near zero, so money was very cheap. But today, that 10-year government bond yield, which was around 1% in Australia in 2020, it's closer to 5% today. So money is very expensive. And we've now got a huge increase in the public debt burden. So in states like Victoria owed the world 40 to 50 billion in 2019, the year before the pandemic. Today, it's heading towards 300 billion. And I don't really see that we've got much return on that money. So my argument in respect to the RBA today has been that they've got the cash rate at 3.6%. They think normal is about 3%. We've seen an uptick in inflation where it's burst the top of the RBA's target 2 to 3% band, and that's resulted in a clamour of calls for the RBA to lift rates again. And it would be really quite singularly embarrassing because they'd be the first central bank in the world, aside from the Bank of Japan, to lift rates if they do indeed raise rates in February. And basically they would be signalling that the easing cycle had failed. They were mistaken to cut rates. And remember, the RBA boasted relentlessly about the fact that it didn't lift rates as far as all the other peer central banks, which generally went to 5 to 6%. The RBA stopped at 4.35%. Historically, the RBA had held its cash rate much higher than the Fed over different business cycles, but this time it was different. One of the reasons it might have been different was that Jim Chalmers, the federal treasurer, appointed most of the RBA board that makes these interest rate decisions, but he also singularly appointed the new governor, Michelle Bullock, and her deputy, Andrew Hauser. So these were Jim Chalmers' appointments. And ever since he's made those appointments, the RBA has been very dovish, but also the RBA has been super gun shy about getting involved in any public debates with respect to fiscal policy. So they've been totally MIA on fiscal policy. And the problem is, of course, that government spending as a share of the economy is on some measures at its highest level since World War II. So public spending has been driving all the employment growth and economic growth in Australia, not the private sector. And were it not for these gargantuan budget deficits, interest rates in Australia would actually be much lower. So the simple solution to get the pressure off rates, and certainly the prospect of rates rising in the future, is by convincing the politicians to start trying to balance their budgets, and they're not remotely close to balancing the budgets. We've again got seen this huge increase in the contribution of the public sector to the overall economy, and the collateral damage in that process has been entrepreneurship, innovation, activity by the private sector, and productivity. We've got the worst productivity growth in Australia since World War II, and that's both a public sector story but also a private sector story. And what's really sad is Australia on all productivity measures, whether it's labour productivity or total multi-factor productivity, is lagging the rest of the world, and in particular lagging very significantly the United States and even Europe, which is amazing. So politicians need to encourage much more innovation, much more private investment, much more entrepreneurship, and they need to give Aussies incentives to work harder rather than constantly being the insurer of last resort, constantly bailing people out of their problems, bailing businesses out of their problems. And the RBA needs to step up and say, listen, if we spent less publicly, that would create more room for private activity, but it would also reduce pressure on interest rates in terms of rates potentially rising. And thus far, we've seen no engagement at all from the RBA. So this speaks to your question about the lack of leadership. And I think in Australia, I've sort of coined this phrase that we're likely to become Asia's Ibiza, really trading on our physical amenities, our beaches, our coastlines, our barrier reef, our natural physical beauty. The risk is we don't really produce anything in Australia. We don't have much entrepreneurship or innovation. We just become a tourist destination for the wealthy members of the Indo-Pacific region. And that is a big fear I have. I see a lot of Australians who are moving overseas and trying to avail themselves of better opportunities overseas. And in Australia, public purse seems to be a panacea for all problems. And that's really deeply worrying. The challenge for the RBA here and now in 2026 is to put pressure on politicians to balance their books, spend less, encourage more private activity, and then we could live in a world where we could actually have lower rather than higher interest rates.
Chris, just to follow up there, if I may, I don't disagree with anything that you said, but there's a well-known saying that ultimately reads is you will get the government that you deserve. What responsibility do we as a people have to take for not demanding more from our politicians?
Yeah, I think as I said in the AFR recently, the lucky country has become the lazy land. And that's because we've basically had uninterrupted economic growth since the early 1990s. We haven't had a proper recession since 1991. That's largely a function of two factors. We had phenomenal and globally almost peerless endowments of natural resources, our iron ore, our coal, our LNG, our gold, uranium, and so on. This has allowed us to sell those physical wares to the world and trade a huge amount of resources-related wealth in the process. And that in turn precipitated many years of significant budget surpluses. Prior to the 2008 crisis, there was actually talk of disappearing the Aussie government bond market altogether because of the magnitude of those fiscal surpluses. Obviously, the world looks very different today with trillions of dollars of Aussie government debt and every state basically producing very large budget deficits, save for the occasional exception in Western Australia. So on the one hand, we had what people refer to as Dutch disease, whereby you get this moral hazard and complacency by being a country that's so wealthy through its natural endowments and resources. The other thing that we've run in Australia has been world-beating population growth, and we've run phenomenal migration. Our population base is increasing by almost 20% every decade. Imagine that. So Sydney as a city is growing by probably more than 20% every decade. And that's changing the complexion of Australia. It's obviously created some integration and assimilation issues where we've had cultural conflicts, as we saw in Bondi, tragically. And I think you're right. There's been a lowest common denominator pandering to complacency and prejudice through these sort of levers of good fortune and providence that have been bequeathed through the natural resources and the extreme population growth. Australia today feels like a very, very different country, to be frank, than the one that I grew up in. The Australian character, the Australian values, the Australian aspiration just doesn't seem to be something that I recognise today. It's not necessarily a bad thing because we want to evolve and adapt, but I kind of feel that we've absolutely and emphatically lost our way. And I think everybody looks to politicians now to provide solutions to our problems rather than looking to themselves. And I think challenge in Australia, I feel like we're heading, and Victoria's at the vanguard of this process, we're heading down the path of, if you look at almost failed states like California in the US, we're heading down that path where the state intervenes to an extreme degree in individual liberties and private lives. And in the US, they've had a cathartic crisis, and they've also had, I think, an ideological conflict between the left and right. And that's played out between the extraordinary success of Texas and Florida, where they're running huge budget surpluses and crime is comparatively low and businesses are flourishing. And you look at the mass exodus of people and businesses out of now New York and California, run by the left, where crime is on a secular basis higher, poverty is much higher, and both states are running large budget deficits. So I think we've yet to have that cathartic crisis because we didn't have a really tough 2008. We didn't have, in contrast to the United States, we didn't have the same difficulties that other countries faced in the pandemic. And we haven't really had that economic cataclysm, that economic bushfire that we had really in 1991 since that time. And that process it's called creative destruction, where struggling businesses fail and the people and the capital associated with those businesses flee to other more productive and vibrant opportunities. It is an integral part of capitalism itself, basically punishing bad businesses and encouraging new ones to thrive up in their or rise up in their stead. And in Australia, I don't feel like we've had that creative destruction for a very, very long time. So there's an enormous amount of moral hazard. There's an enormous amount of complacency, and the incentive to work hard has been dulled by the fact that the state is trying to put 1 in 2 Australians directly or indirectly on the public payroll, because that's been the Dan Andrews playbook in Victoria, which has been electorally very successful, but conflicting voters financially, and by paying for so many public services, you can compromise their decision-making process and perpetuate your regime of power. So, yeah, that's the challenge, and I think we're going to need a cathartic crisis in order to stimulate change. And I think the manifestation of that in the US is the current Trump administration, which is kind of a reaction to that crisis. And Trump's been produced by the system. You're seeing in the UK, Farage has been produced by that system, and by or judging on the availability of public polling, he would win an election were one to be held today. And across Europe, you're also seeing the rise of the centre right in reaction to these problems, these pervasive problems. So when that happens in Australia, I'm not sure, but obviously the recent rise of One Nation in some polling is perhaps an exemplar of that process.
Well, Chris, as a Victorian, I couldn't agree with you more. It's very sad seeing what has happened to this state. And I would love to continue this conversation with you, perhaps over a $25 beer, either in Sydney or in Melbourne sometime, because there's a lot in it. But Well, straighten up a little bit. Your base case for Aussie interest rates in 2026, and then some of the data points that you keep an eye on or you think about as you think about that process.
The key is core inflation. We're about to get the latest batch of the fourth quarter inflation data. The sense in markets is that if it comes out on a quarterly basis at 0.8 to 0.9%, the RBA might hold. The RBA certainly seems in no rush to raise rates. They clearly like to hold rates steady. Rates are not low in Australia, so the cash rate at 3.6%, as I mentioned earlier, is actually meaningfully above the RBA's last estimate of the so-called normal or neutral rate and should be exercising a restraining influence on activity. But you've got so much public spending powering the economy that the fiscal policy, which is providing extreme stimulus, is obviously working in direct opposition to the restraining influence of monetary policy. I think in 2026, the likely outcome for rates is sort of plus or minus one or two moves around the current threshold. So I think stability is more likely than cuts, certainly. And there is a risk that they are forced to hike once or twice, but I don't think they'll hike many times if they do start raising rates. I think that will trigger a huge public furor around the role of political spending in the economy. And the RBA has these massive cards to play in terms of the public debate around fiscal policy. And I think they will play those cards. I think that's almost inevitable. We are seeing some of this debate starting to emerge in the financial media. So there's quite a lot of talk about the need for fiscal restraint. So yeah, I think rates to remain on hold in 2026. There is a risk that they chisel out a few or one or two hikes, but I think it's subject to the data. I mean, again, it's a bit of a line ball call. If we got a 1% core inflation print, they probably would lift rates, but I think it would be more a shot across the bows. So one or two hikes, if we get them, would be the end of that process. I also think it would have an immediate impact on house prices and the other interest rate sensitive sectors of the economy, and people will be very, very disappointed, having been conditioned last year to expect significant cuts. The RBA delivered 3, but the market was pricing in 5 to 6, and we only obviously got those 3. So yeah, I think stability for monetary policy. Where I'm looking for consolidation and changes on fiscal policy in 2026.
Chris, last question. Just any thoughts for investors, particularly as it regards your space fixed income as we head into 2026? What would you like to leave viewers with?
Yeah, so the big ideas we have in fixed income markets are there's basically been a shift in risk premium from bank bonds and corporate bonds to government bonds. So people are worried about public spending. They're worried about budget deficits deteriorating. They're worried clearly about higher rather than lower inflation. They're worried that inflation rates won't stabilize around the central bank targets. They're worried about the politicization of central banks. We've seen Trump have a very aggressive go at Jerome Powell, the chairman of the US Federal Reserve. I think that little drama is interesting in terms of an insight into Trump. Trump's a huge believer in an eye for an eye. And I think most people in markets felt that the Fed, and Powell particularly, was being quite political prior to the US election last year, or sorry, in 2024. The Fed felt like it was really pulling hard for a Democrat result. That was, I think, a quasi-consensus view in markets. It was very keen to cut rates ahead of that election and guide markets to think more rate cuts would come after the election. And then as soon as Trump was elected, they kind of reversed 180 degrees and became incredibly hawkish and gave Trump a really tough time for a long time until they capitulated again and started cutting rates. And so I think Trump feels that he needs to make an example of Powell because Powell tried to make an example of him, and it's an eye for an eye. I don't think it's much more than that. I think the Department of Justice investigation into the construction of the new US Federal Reserve buildings is just about retribution. I don't think it's going to undermine the Fed's independence in the medium term. So my view is the Fed's going to do what it's going to do. It doesn't matter what who Trump appoints. Now, remember, every nation state leader is ultimately going to appoint representatives to their central banks' decision-making bodies, and typically they'll appoint the governor and deputy governor, as Jim Chalmers did here in Australia. Trump's just been much more explicit in his communicating his displeasure with the Fed, which I actually have no problem with politicians expressing views on rates, in the same way that I have no dramas whatsoever with central banks expressing views on fiscal policy. I think we should be kind of comfortable and adult enough to have public debates around these policy matters. So coming back to our market, that was a bit of a segue. My key point was going to be that we've seen credit spreads tighten, but we've seen what are called term premia widen. Now, term premia are the difference between short-term interest rates and long-term interest rates. And for decades, those term premia were either zero or negative, and now they're very, very positive. So the Aussie 10-year government bond yield is almost 5%, whereas the RBA cash rate is 3.6%. So you've got a very positive slope in that yield curve. And you've got the advent of positive term premia. And what that has meant is that whilst credit risk requirements or the compensation for credit risk in bank bond and corporate bond markets has declined, the compensation for fiscal policy risk and inflation risk in government bond markets has increased. So those things are trading off. And what that means crucially is that the all-in yield that you're getting on bonds is actually still very, very attractive. So, in our portfolios, we have strategies paying cash running yields of close to 7%. And that's because you're getting a very high cash rate, that 3.6% cash rate, plus in some cases you're getting this very positive term premium if you've got a fixed rate exposure that's giving you some leverage to the yield curve. And then you're also getting the credit spread on top of that, and then you might overlay some leverage to further enhance that yield. So all out or outright yields are attractive right now. And we like duration, we like fixed rate bond exposures. So that's one key point. I think averaging into duration with these very high yields makes a huge amount of sense, because if something goes wrong in the world, the RBA has to cut the cash rate, the value of fixed rate bonds will go through the roof and duration will pay huge dividends. The best performing part of the bond market globally last year in 2025 was actually fixed rate global investment grade bonds, which paid a return of about 7%. Our funds that are benchmarked against that global aggregate index outperformed significantly after fees. Duration was the best performing asset class in bond markets. Not to bore everyone, but you've basically got two types of bonds: a floating rate bond and a fixed rate bond. And fixed rate bonds lock in their interest rate like a term deposit, whereas floating rate bonds provide variable rates that move up and down with the RBA cash rate. And if you invest in a fixed rate bond, you're basically taking a bit of a bet on the future direction rates, and you profit if rates go down rather than go up. And duration actually did really well offshore. It did less well in Australia. Why? Because the Fed cut last year and was expected to cut more, whereas here in Australia, yes, the RBA cut, but then we moved at the end of the year into a new regime where people thought the RBA would hike, and hikes are still, or were still priced in 2026 for the RBA. So Aussie duration didn't do so well. Aussie floating rate bonds actually did quite well, paying about 5% last year versus the 3.6% cash rate. Floating rate bonds offshore also did well, but duration did better. So the first key point would be I like global duration, but I also like Aussie duration. The second key point would be I don't really like the hybrid market. Hybrid spreads on the ASX, so bank hybrids are paying pretty much the lowest spreads we've seen, which is a spread is basically a proxy for the risk premium, or the extra return you get for the risk of a hybrid. They're getting paid the lowest spreads that we've seen since before the GFC, so since about 2007. So a 5-year major bank hybrid is paying you about 1.8% above cash, whereas previously, or since 2013, a 5-year major bank hybrid's paid you about 3 to 3.5% above cash. So that spread has come in dramatically, and our preference is to move.
Is that because that market is being phased out, or is it the bigger forces impact? Yep.
So there's a good reason for that, which I'll come to, but our preference is to sell hybrids and move up the capital stack. Subordinated bonds have been a very popular hybrid replacement strategy, but those spreads are also really tight. The cheapest part of the capital stack is actually senior ranking bonds, which are the safest bonds, the best rated bonds, the most liquid bonds, and that's probably our biggest position in Australia here. But as you rightly point out, the reason hybrid spreads have come in is that bank hybrids are being phased out by 2032. Obviously, that's a long time away, and we are seeing other types of hybrids issued. So while the bank hybrids are disappearing, insurers can still issue hybrids, and crucially, foreign banks are coming to Australia and issuing hybrids. So we saw UBS last year come and issue a hybrid. We saw BNP, the French bank, come and issue a hybrid, and then we've seen a ton of corporates come and issue hybrids. So we are getting replacements, and then you're also seeing a tsunami of private credit funds listed on the ASX. Through these things called listed investment trusts, or LITs. And that tsunami of private credit funds is trying to convince people to sell bank hybrids to buy risky illiquid debt with high default risks. And those two things are very, very different propositions. I think private credit has a role to play in portfolios. But again, our preference is to go up the capital stack to the cheapest senior ranking bonds. And then we like to apply some leverage to those bonds to basically give you a yield that's better than the hybrid market, with a better credit rating than the hybrid market, with better liquidity than the hybrid market, and lower default risks, but the same overall return volatility or portfolio variability, but with a better, demonstrably superior yield. So that's our kind of take. One final point I make on the bond market in 2026 is that there is a lot of debt being issued. So, for example, these tech companies never used to issue debt because they didn't have any debt. But now that they're having to, the so-called hyperscalers, the Googles, Metas, Amazons, Microsofts, et al., now that they're having to fund these huge data center rollouts, they're issuing big debt deals. And we estimate that within a few years, the tech companies will be up to 20% of the entire global bond market. So they've gone from a tiny percentage of the global bond market to what will become a very meaningful sort of part of the market, almost as big as 1/5 of the entire market. And that new bond issuance is creating huge trading opportunities. So as the Amazons, Googles, Metas issue these massive $10 billion plus in US dollars, multi-tranche deals, we are seeing huge opportunities around the world and in Australia. So we're expecting them to come to Australia. And then the final thing in a related vein would be, as we're seeing governments run these huge budget deficits as they engage in this global arms race to militarize after years of underspending on defence, particularly the European nations. We're seeing tremendous amounts of public debt issuance around the world that's liquid and highly rated, and that's also creating big opportunities. So we think being bond market bandit is a really exciting thing in 2026, with the world awash with lots of debt and much more debt to come. We think the macro is super interesting and important to understand, analyze, and try and forecast, because at the margin it can help, even though trading macro is notoriously very difficult to monetize. And I think the US is in a very different station to Australia. I think Australia's a little screwed right now without the presence of a cathartic contemporaneous crisis, whereas the US has had, I think, their crisis, or they're having their crisis, and they've got this massive ideological debate sort of playing out. And I think you're seeing some super interesting economic policies coming out of the US, but also quite radical new geopolitical approaches coming out of the US that are reshaping the world and also reshaping markets.
Chris, thanks so much for sitting down and having a chat with Livewire. Very much appreciate it. As always, covered a lot of ground, and it's great getting your insights across a range of issues, particularly when a lot of the funds management community is still on holidays.
Thanks, brother.
If you enjoyed that interview, make sure to give it a like, and don't forget to follow our YouTube channel. We're adding lots of great content every single week.